You've been told that dividend stocks are the effortless way to wealth, the ultimate set it and forget it strategy to retire early. But in 2026, that promise is getting expensive. If you plan to dump your life savings into a few high-yield stocks and live off the checks forever, you are walking toward a mathematical buzzsaw. Today, we're breaking down the reality of the dividend dream and the specific calculations you need to see before you buy another share. Sticking to these strategies can shrink your net worth, even as the checks keep arriving. We are living in an era where inflation has shifted the goalposts, and record-high credit card debt has become a new, unstable American safety net. Most people find themselves trying to out-earn their spending habits, while treating savings as an afterthought at the end of the month. This creates a psychological trap where a 7 or 8% dividend yield looks like a magical shortcut to wealth. But applying financial logic from the 1990s to the current economic landscape rarely produces the results investors expect. Focusing exclusively on yield often leaves investors with a portfolio that fails to keep pace with the actual cost of a modern lifestyle. Breaking this cycle requires a rejection of systems engineered to keep you in debt. You have to treat your future self as your most critical monthly bill. This graph shows the median American net worth hovering around $217,000. Even at a generous 5% yield, that net worth generates just $10,850 yearly. You cannot live on that. To actually walk away from your job, you need a massive pile of capital, rather than just a different stock pick. Solving the retirement equation depends on the total volume of your capital, regardless of which high-yield ticker you choose. We can calculate the exact point of financial independence by using a specific freedom number formula. To generate $50,000 yearly, a growth portfolio like Apple, yielding 0.39%, needs $12.8 million. Dividend Aristocrats like Pepsi drops this to $1.31 million, while aggressive high-yield portfolios hit the target at $1 million flat. But that $1 million shortcut comes with a hidden cost. Legacy companies like 3M, Walgreens, and AT&T have all slashed their dividends recently after decades of increases, often because their stock prices were tanking. A more durable strategy focuses on total return, the combination of both market growth and the dividend. Relying solely on high yields leaves you vulnerable to dividend cuts and capital loss, making total return a more reliable path for long-term investors. If you are under 35, small dividend checks are a distraction. A $10,000 portfolio at a 4% yield only pays out $400 a year, the price of a nice dinner, not a retirement. At this stage, time is your most valuable asset. This curve shows the impact of redirecting $15 a day, the price of a delivered lunch, into a growth-focused index. Over decades, compound interest turns those small daily actions into a financial snowball. This growth-focused approach can accumulate hundreds of thousands of dollars more than a dividend-heavy portfolio because it benefits from higher compound interest and lower tax drag. These small daily habits, paired with time, consistently outperform the stagnant returns of chasing dividends early in your career. The strategy for 2026 is simple. Prioritize growth until you have enough capital to make a dividend yield meaningful. If you were handed $1 million today, would you choose a 5% dividend yield or 10% market growth? Let me know which one you'd pick in the comments. If you want to see how this fits into a larger plan, I've linked a video here detailing the 4 specific numbers you need to track to retire early. True financial freedom comes from choosing the mathematical certainty of long-term growth over the immediate gratification of a small check. Thank you for watching. Peace.